Hey everybody, JJ here, Bull to the Bust. We are seeing a staggering number of young people moving back in with their parents. And today we're going to look at the correlation between home prices and income and debt. Let's get started. Recent article right here, the new boomerang kids could change American views of living at home. Now, in a recent analysis of government data by Zillow, it indicated that 2.9 million adults moved in with their parents or grandparents in March, April, and May. Now, a lot of you may be quick to point this to the shutdown because of the virus, right? That is not the only cause. Of course, that escalated the issue, and a lot more people had to move home just in the past few months, especially when you look at all the kids that could no longer stay in college because of the pandemic. But even before this, the situation was really bad with stagnant wages, rising home prices, the rising cost of living, especially the rising cost of education. And let's go right to a chart right here. This is still out of this Atlantic article. And some of you may be saying, well, yeah, the population's increasing, so of course more people are going to move at home because there's more people. Well, not so fast. This is the percentage of Americans aged 25 to 34 living with their parents now from 83 to 2019. Now when the 2020 final numbers come out, it's probably going to take another big jump over here. But right now we can still see the trend over the past decade or so. And this chart goes all the way into the 80s, but let's focus on the mid-2000s here. And it's interesting that we see that as home prices started increasing in the mid-2000s, leading up to the 2007-2008 financial crisis, we see more and more people, percentage-wise, moving at home with their parents. Now this is 25 to 34-year-olds, so it's young people. And of course we know that young people typically are the most challenged as far as being able to afford an entry-level home, especially as home prices continue to get higher and the cost of education and again the cost of living continues to get higher at the same time. And stagnant wages, which we're also going to talk about more, but look at this, into the mid-2000s, more and more people moving at home, the number grew, and we did see a little bit of a dip here after the end of the financial crisis. After the housing bubble went bust, we saw a little bit of a drop right here, 2010, 11, 12. Home prices were actually very affordable during those brief few years, 2011, 2013, and then they started rising again. And sure enough, what do we see when home prices started recovering and rising once again? Another surge in young people moving back home. No coincidence that home prices, young people moving back home with their parents. Now, we've talked plenty of times in plenty of different videos about the reason for the high cost of living, and a lot of it has to do with supply and demand and easy money, loose lending, right? So what happens to the cost of education when anyone can get a student loan? Well, the colleges are going to continually raise their costs because the government is backing these student loans. The same thing with banks, endless bailouts, endless stimulus, liquidity injections, loosening the lending guidelines, completely taking away, back in March, taking away the fractional reserve requirement for banks to be able to lend, and on and on. So lending creates inflation, and guess what would happen if banks stopped lending? Well, you would see massive deflation and crashing prices, falling home prices, falling rents, millions of lost jobs. So that's why you see this ever-increasing attempt to keep the banking system liquefied, keep it propped up, backdoor bailouts, stimulus, liquidity injections, you name it. Now let's go to another chart right here. This is Wolf Street, wolfstreet.com. Now this only goes up to 2017, but you'll get the picture, believe me. Median household income in the red right here, very stagnant over the past few decades. And look at the blue line, that is the median home price. The yellow is the median rent. So you can see why so many people, most people are living paycheck to paycheck because people are stretching their budgets beyond their means to get into a home, and even rents. People are using a larger and larger percentage of their monthly income going towards housing, whether it be rent or purchasing a home and the cost of the monthly mortgage. And this is still with ultra low mortgage rates. So low mortgage rates just allows people to borrow more. People aren't looking at the price of the home typically, they're just looking at the monthly payment, and they're asking themselves, hey, can I afford the monthly payment? Well, believe me, I talked to a lot of people in my line of work, and a lot of them went broke thinking they can afford the monthly payment, counting on, crossing their fingers that nothing bad would ever happen. There's not going to be a recession in the next 30 years. There's not going to be any sort of economic downturn. no pandemic, no job losses. People are gambling on a 30-year mortgage with home prices that are drastically disconnected from incomes, and it doesn't take much. It doesn't take a brain surgeon. Just look at the chart right here. You can see the disconnect. And it's even more disconnected in some areas. Let's take a look at some of the bubble cities down here. Same article out of Wolf Street. Take a look at Los Angeles. And it's no coincidence that in 1970 we started seeing this huge disconnect. What happened in the early 70s? 1971 to be precise. We came off the gold standard. The dollar starting in 1971 was completely detached from gold. And that really allowed the lending to ramp up. And what happens when there's more lending, there's more spending. And simple, right? Home prices are going to get bid up. And of course we did see downturns, especially exaggerated in these high home price markets like Los Angeles, like we're looking at right here. But when this fiat dollar experiment ends, and it's likely going to end very soon, we're approaching 50 years. Next year, 2021, will be 50 years since we came off that gold standard in 71. Right? Now, I'm not saying this is going to happen tomorrow, but this correction is going to be absolutely devastating. It's going to be brutal. And if you've been watching our videos, you know that the real number of unemployment is closer to 50% when you look at working age individuals. We just talked about that 2 videos ago there, or 3 videos ago. We know that there's 100 million loans that are late right now and in forbearance, and payments halted on those loans. Also, in many areas, people can't pay the utility bills, and they're having to put a freeze on utilities, otherwise their power will get shut off, no lights, maybe no heat for some of these people. So it's very, very dangerous times right now in our country. And ask yourself, can home prices still keep increasing? Can rents still keep increasing when there's so many people without jobs, and the people that are getting their jobs back, well, their employers are not offering them raises on a large scale. Some of the bigger employers are. There was recent news that Target was raising their minimum wage, I think, to $15, but still nothing near enough to help people keep up with the rising cost of living and these outrageous home prices. So the home price correction is going to happen, the housing market correction is going to happen in the next, I'd say in the next year. Now, you never know what other tricks that the Fed can pull out of their hat. We do know that more stimulus checks are going to be coming out probably around August. We'll touch on that in our next video. We know that there's moratoriums right now on evictions. There's foreclosures that are being prevented from happening. Recent CNBC article right here. Experts fear the end of the eviction moratoriums could plunge thousands of people into homelessness. Now, we've been talking about this, but the federal mandate prohibiting evictions or foreclosures ends July 24th. Now, they're likely going to have to expand that because the last thing that any politician wants right now is to have this whole housing market implode and have millions of new homeless people emerge, so to speak, on their watch. So expect more manipulation, more stimulus checks. We'll see what happens with taxes. They haven't pushed the deadline back further, but we're going to keep an eye on that. I think they're going to have to do that. And I think this year we're going to see some pretty amazing, shocking things that probably many of us would have never expected. Now let's look at some numbers here. This is the same NBC article. In Tucson, Arizona, courts are processing an average of 52 eviction cases per day. And that's according to the Arizona Daily Star. In Tennessee, more than 9,000 eviction hearings are pending, about 33% more cases than normal for this time of year. And it's pretty similar in many parts of the country. Certain cities are putting in different regulations as far as moratoriums. So you're going to have to see how this plays out in your local area. I can't cover thousands of different cities, obviously. But we do know that overall this is a very, very dangerous position for our country and for the financial system and for millions of people. Right, so you let me know down in the comments, please, what is this correction going to look like when this market finally blows up, when the housing market is allowed to correct, when things are allowed to flow in a normal manner. If we ever get to normal, you let me know. Will we ever get to normal? If not, what's the correction going to look like? What's your timeline? I have put my timeline in early 2021 because of the important November events coming up this year. What do you think about this chart here that shows an ever-increasing number of young people having to move at home as home prices increase? And how bad do you think it's going to get once these moratoriums are lifted? You let me know. Thanks for watching this report, everybody. Bye for now.